this session, we will be focusing on share capital. Share capital will be found in chapter 23 of your Gripping GAAP textbook. There are various methods that can be used by an entity in order to raise funds. This can be through internal sources, through the profits and accumulated profits in the form of retained earnings of the entity itself. They could also look to external sources, such as loans or debentures and other various debt instruments, as we have studied in financial instruments. They could also look at the owners of the business, so the shareholders, in the form of share capital issue. There are in fact two classes of share capital, which are in the form of ordinary and preference shares. When we look at the definition of a share, it can in fact be an equity or a debt instrument to the entity. And that's really going to be dependent on the terms and conditions that are associated with that particular share. That is going to help us to determine, do we in fact have an equity instrument or a debt instrument? Now, typically with financial instruments, we saw share capital and we immediately would say, oh, that is an equity instrument. But now, after we've studied share capital in more depth, we would be able to more accurately determine, do we in fact have an equity instrument or a debt instrument? A share is a financial asset to the shareholder. An equity instrument is defined as a contract that results in a residual interest in assets after deducting its liabilities. Okay, so that would be our typical definition of equity. It really falls back to our structure of the statement of financial position and our very basic form of the accounting equation. When looking at ordinary and preference dividends, we would need to associate that with the ordinary dividends for ordinary shares and preference dividends for preference shares. Starting off with preference shares, they received a fixed preference dividend annually based on the coupon rate. Okay, so it's important that we are able to identify the coupon rate in a question and know that that rate is what we're going to use when calculating our preference dividend. Shareholders are given preference also in the case of liquidation. So there are certain perks associated with holding preference shares over the ordinary shares. How do we calculate the dividend for preference shares? We use the number of shares times by their RAND value multiplied out by their coupon rate to determine what their preference dividend will be. For ordinary shares, the receipt of dividends is dependent on profitability as well as cash flow of the company. So whereas with the preference shares, they're going to ultimately receive this fixed preference dividend, whether there's a profit made or a loss made, or whatever the case is that's happening with the company, they're still going to receive their value. Whereas for ordinary shares, there's going to be a decision made determined by the profitability and the cash flow of the company. So the directors will sit at a board meeting and they will decide how much are we going to give the ordinary shareholders, if anything. So they're not guaranteed a dividend on an annual basis. How do we calculate our ordinary dividend? We use our number of shares times by the dividend per share. So if they're going to get 10 cents per share and there's 1 million shares, we'd say 1 million shares times by 10 cents gives us a total value of 100,000 Rand. When looking at preference shares in more detail, there's actually a number of different types and variations that we need to be mindful of when we do our tests and exams. So some of the types of preference shares that we might need to be cognizant of is the fact that they can be cumulative or non-cumulative. Now, what they're referring to when they say that preference shares are cumulative or non-cumulative, it's basically talking about the status of the dividends. And so that means that if they're cumulative, means that even if the dividends aren't paid out during a particular financial year, they're still going to accumulate. So like retained earnings, it's still going to accumulate on an annual basis. So it's still going to be owed to them even if it's not paid out. Non-cumulative means if it's not paid out, it's going to fall away. They're not going to receive that. So non-cumulative or discretionary types of dividends mean there's no obligation for the entity to pay those dividends, whereas the cumulative optional non-discretionary means that there's going to be a present obligation on the date of issue of those shares. So immediately when we issue those shares, we know that for the foreseeable future, we're going to have to pay out dividends whether we are able to or not. They're still going to accumulate and we're still going to have the obligation to pay that out to the preference shareholders. So dividends must be paid. So if the company is unable to pay their dividends in perhaps next year or perhaps this year with the pandemic, the amount will accrue to the shareholders until they are in fact paid. And no ordinary dividends will be paid until all the cumulative preference dividends are paid. So as you can see, there's always this preference over the ordinary shareholders. So if a question tells us that ordinary shareholders or ordinary dividends are being paid, we automatically know that all our cumulative preference dividends are also being paid out. Our preference shares in this type of a scenario are seen as liabilities, or our preference dividends. These would be recognized in the form of finance costs in our statements of profit or loss. When looking at preference shares, we also come across this option of whether they are redeemable or non-redeemable. Now, when they're redeemable, that would mean that the company is going to pay out for those shares to the shareholder at a specific date in the future. So it's almost, it's certain that in the future, these preference shares are going to be purchased back by the company. They're redeemable. So as a future outflow, therefore we know that we have a liability. But legally, these are still considered to be some form of share. So we have to also look at the substance over the legal form. In substance, we know that this is ultimately a liability. While we see legal form, yes, it's a preference share, so it looks like equity. If we look at the substance of the transaction, these shares are generating an obligation that we have to pay at some point in the future. So we have to compulsory redeem them in the future at a specified date at a specified price. And now when we talk about redemption, there could be a number of different scenarios that are applicable. So firstly, if it's redemption at the option of the company, we would consider them to be equity, because quite often the company is not going to want to pay out for those shares. They do want these shareholders to be invested in the entity, and they would want it to form part of the equity of the company. If the redemption is either compulsory or at the option of the shareholder, it would be a more prudent approach to account for that preference share as being a liability. Okay, so compulsory redeemable, we know that at the specified date, we are going to have to pay back at the specified price. The option of the shareholder, we don't know what the shareholder is ultimately going to decide and when they're going to want to redeem. So it's always expected that these are going to be recorded as being a liability. That would be the more prudent approach in that regard. And if they are non-redeemable, then we simply assume that that will be recorded as equity. And so we don't expect that that is something that would be included as a liability. If they're not redeemable, would be seen as functioning in the similar manner of an ordinary preference share and account for that as being equity. So as we can see, a few nuances can change a share from being equity to in fact now forming part of a liability. Okay, so redeeming a preference share. This is where we're ultimately returning the capital to the preference shareholder. So their shareholder is going to be giving their share back, and we are going to be giving them a fixed price for an exchange of that preference share. We're now going to look at example 2 from your Gripping GARP textbook. And this example tells us that Glow Limited issued on the 1st of January 20X1 50,000 10% non-redeemable, non-cumulative preference shares of R2 each. Also 100,000 ordinary shares at R3.50 each. The authorized share capital means half of the authorized ordinary and preference shares have been issued. So if half have been issued, that then means the total authorized value of preference shares would be 100,000 and for ordinary shares would be 200,000. Other information we are provided with is that all preference dividends were declared and paid before year end, with the exception of 20X6, when the preference dividend was declared but not paid. You are required to prepare all the journal entries from the date of issue of the preference shares to the 31st of December 20X6. You are also required to disclose the ordinary and preference shares in financial statements for the year ended 31st of December X6, and no comparatives for the statement of changes in equity are required. So, from the information we're given, we know that the initial issue of these preference shares was going to be 50,000 preference shares at R2 each. So debit bank with 100,000 Rand, 50,000 shares at R2 each, and credit our preference share capital. As you've seen in this chapter, it's going to be very important that we stipulate, are we talking about preference share capital? Are we talking about ordinary share capital? So you must stipulate that in your journal entries. When we look at our ordinary shares, it was 100,000 ordinary shares at R3.50 each. So they didn't show the journal for that, but how would it have looked? Debit our bank with the 350,000 Rand and credit our ordinary share capital with 350,000 Rand. How do we account for our preference dividends? So we debit our preference dividend that ultimately would be a reduction of retained earnings in our statement of change in equity at a value of 10,000 Rand and credit shareholders for dividends at 10,000 Rand. How did they get this 10,000 Rand? Remember our calculation to calculate a preference dividend. We take the number of preference dividends of 50,000 Rand times by the Rand value of R2 each times by the coupon rate of 10%. That then gives us our total preference dividends. When those payments are going to be made for the preference dividends, we now no longer have that shareholders for dividend liability. So to remove that, we would debit it and credit bank to represent the outflow of cash. When looking at our extracts from the statement of financial position, so what do we expect to find? Under equity, we expect to see the ordinary share capital and the preference share capital. So our ordinary share capital shown at a value of 350,000 Rand and our preference share capital at a value of 100,000 Rand. Also under our current liabilities at the end of X6, we expect to see our preference shareholders for dividends of 10,000 Rand that is owing at year end. When looking at our statement of changes in equity, remember we would be having a column for each of the relevant items that reflect in terms of equity. So a column for our ordinary share capital, a column for our preference share capital, and a column for retained earnings. Start off with our opening balance for each of our share capitals, and then we see our preference dividends declared actually being deducted from retained earnings itself. So that must be reflected when you are providing for your journals, and they must filter through as you get worked through your disclosure. When looking at the notes to the financial statements, the ordinary share capital will have its own note separate from your preference share capital. And you'll see under the years, it's written number. So this share note is actually based on the number of shares. It's not the Rand value, which is easy for students to get mixed up. It must be the number of shares. So the authorized number of shares, it's 200,000 shares. In terms of how much was issued, half of that was an issue, which is 100,000 shares. Okay, so not the rand value, very important. The same with the preference share capital. We are not interested in the rand value of the shares themselves. We are interested in the number of shares that is relevant. So the authorized number of shares, total maximum that they're allowed to issue is 100,000 preference shares. How much is an issue? We show a recon, just like you have with PP&E, etc. Issued 50,000 shares in total. Looking at example 3, okay, very similar to our previous example, where the number of shares that are issued on the 1st of Jan 20X1 is 50,000 10% redeemable preference shares of R2 and 100,000 ordinary shares at R3.50 each. There are a total of 120,000 authorized ordinary shares. Okay. We were then also told that payment of preference dividends is mandatory and payable on the 31st of December each year at the 10% coupon rate applied to the deemed value of R2 per share. Half of the authorized preference shares have been issued, and the preference shares must be redeemed on the 30th of December 20X3 at a premium of 20 cents per share. We're also given the effective rate of interest of 12.93699016%. Okay, so as we can see here, what has changed slightly from before? Okay, if we look at it from previously, the previous example did not have these redeemable preference shares with a mandatory fixed date in 3 years' time. Okay, so because these shares are in fact redeemable at a fixed date, we would want to treat them similarly to a financial liability. We're also told in this question that the retained earnings on the 1st of Jan 20X2 was 150,000 Rand. And the total comprehensive income after the previous information was 80,000 Rand in 20X2. There was also an ordinary dividend of 10,000 Rand declared in 20X2. You're required to provide all the journal entries for 20X1 as well as disclose the ordinary and preference shares in the financial statements for the year ended 31st of December 20X5. No comparatives are required for the statement of changes in equity. Okay, so we said that in this scenario, because of the fact of the preference shares being redeemable at a fixed date for a fixed price in the future, we would need to treat them similarly to a financial liability. So we would want to include that as a form of amortized cost. So we would want to start off with our opening balance and account for interest and payments. So our opening balance for our redeemable preference shares is 50,000 shares at R2 each, means the opening balance will be at a value of 100,000 Rand. We then need to account for interest. We take that 100,000 Rand and multiply it by our effective interest rate to get our interest for 20X1. We then need to account for payments, which would be in the form of a dividend. How do we work out the dividend? It's the 50,000 redeemable preference shares times by R2 each times by a coupon rate of 10%. That then gives us our annual payments, and we can now update our liability balance. As you can then see, at the end of 3 years, our liability balance is sitting at 110,000 Rand. And if we look at the information in the question, they said that these 50,000 shares are going to be redeemed at a premium of 20 cents per share. So that means that we issued these shares at R2 each, but we're going to pay back R2.20 each. So R2.20 times by 50,000 shares means that on the 31st of December 20X3, we expect to be paying back 110,000 Rand. And that does agree with our effective interest table. So we can see that we didn't make any mistakes when providing for our calculation. We now can use this information as we provide our journal entries for the transaction. So starting off on the 1st of Jan 20X1, this is where we are issuing the preference shares. We debit bank because we are receiving money in exchange for those preference shares. and we credit our preference share liability. So as you can see, we haven't called it share capital because in this case, the substance of the transaction is such that these preference shares are ultimately reflecting a liability. At the end of December X1, we now need to account for the interest as well as the payment. The payment is essentially the dividend. Okay, so we need to look back at our interest rate tables for this information so we can populate these two journal entries. Our interest at the end of X1 was 12,937 Rand. How do we provide for this in terms of a journal entry? We debit the interest expense because, of course, we have a financial liability as per our first journal entry, and credit the preference share liability. When we account for the dividend, we are simply going to credit bank to reflect that actual payment, and our contra account will be debit preference share liability. Okay, so slightly different to what you would expect when you are dealing with an equity instrument. Here we are treating these preference shares as a debt instrument and accounting for interest and an annual payment. When we work through our following financial year 20X2, again, you'll use the same information from your effective interest rate table. For year 2, the interest was 13,317 Rand. We record our interest by debiting the interest expense and crediting our contra account, being the preference share liability. We then again record that annual dividend payment by crediting bank to show the outflow of money and debiting our contra account as the preference share liability. On the 31st of December 20X3, we can now reflect our final element of interest and payments. So the final payment is 13,746 Rand, taken from the 4th row of our effective interest rate table. And so we record that as our interest expense, credit our preference share liability, our final dividend payments, debit our liability credit bank, and then we need to show the actual redemption of those preference shares. So debit the preference share liability with the full 110,000 Rand and credit bank. Remember, that was the redemption of the preference shares at a value of 2.20 Rand times by the 50,000 preference shares, means that a total outflow of money of 110,000 Rand is reflected as the payment and reimbursement to the preference shareholders. How would this be reflected in the statement of profit or loss and other comprehensive income? So we would expect to see those interest values shown as forming part of the finance charges. So under our finance charges, we would expect to include those values. We have our total comprehensive income value of 80,000 Rand that we were given from the question itself. When we look at the statement of change in equity, now would we show here our preference share capital? And the answer is no. Our preference share capital is not equity. We've determined that to be a financial liability. So in our statement of change in equity, we only want the equity elements. So ordinary share capital and our retained earnings. Again, would we see here our preference dividends coming off of retained earnings? No, that preference share dividend is actually going to go directly to the liability itself, as you saw going through our journal entries. So very, very important that you're able to establish, is that preference share capital debt or equity, because that's going to affect even your disclosure. So here we have only the equity elements and we don't have our preference share capital because that is in fact a financial liability, does not form part of equity. When we look at our equity portion of the statement of financial position, here remember this filters directly from our statement of change in equity. So what two columns did we have here? Ordinary share capital and retained earnings. So we expect to see two rows under equity in our statement of financial position for ordinary share capital and retained earnings. These closing balances should be taken directly from our statement of changes in equity, and this should not need to be worked out again. It should simply be driven directly from your statement of change in equity and pulled through into your statement of financial position. As you can see on 20X1, our redeemable preference shares at that stage were going to be paid in 2 years' time. So it was non-current, and that balance is equivalent to what was shown in our effective interest rate table. For 20X2, it then becomes current because we're going to pay it within the next financial year. We're going to pay it at 31st of December 20X3, so it then becomes current, and that balance, as per our effective interest rate table, will be shown as a current liability. Okay, so like we said, very important that we understand, do we have equity or do we have a financial liability or debt instrument associated with the terms and conditions of those shares? When looking at the accounting policies, so what do you expect to include under preference shares? Okay, we've said what type of preference shares, what is the terms and conditions that are attached to these preference shares? Well, they are redeemable. When are they redeemable? They're redeemable at 31st of December 20X3. Okay, they're compulsory redeemable and therefore are recognized as liabilities, making sure that we apply the notion of substance over form. And in substance, we know we have an obligation to pay this back in the future. Therefore, it must be recognized as a liability. The dividends on such preference shares are recognized in the statement of profit or loss and other comprehensive income in the form of finance charges. So they're ultimately amalgamated together in those values shown in our statements of profit or loss using the effective interest rate method. And you would want to provide what that effective interest rate in fact is. When looking at the ordinary stated capital note, again, remember this is based on the number of shares. It's not the rand value, it's the number of actual shares. So the authorized number of shares being the maximum that they are allowed to issue, and then how many shares have been issued during the year. Remember, some form of reconciliation being shown between the opening balance and closing balance in terms of issued number of shares. Now, what is interesting is even though your redeemable preference share is liability, so as you can see, it's not written redeemable preference share capital, it's written redeemable preference share liability. It's still going to have a note. Even though it is not considered to be part of equity, we are still going to have a note regarding these number of shares, how many are authorized and how many are currently in issue. At the end of that reconciliation, you do need to provide a little bit of qualitative information that will be relevant for the users of the financial statements. So redeemable preference shares of no par value are compulsory redeemable on, so put the date. When are they redeemable? What price are they going to be redeemed at? They're redeeming at R2.20, so at a premium of 20 cents per share. They are 10% preference shares that are dividends that are cumulative, and what is the effective interest rate that you have applied. So a lot of information needs to be provided to the shareholders and users of the financial statements. Some other elements of preference shares that you need to be mindful of is whether they are participating or non-participating. Now, what are they referring to when they are saying that preference shares are either participating or non-participating? They're actually talking about whether they share in part of the profits or not. So non-participating preference dividends or shareholders don't actually participate in the profit itself. So they're only going to get that fixed annual dividend based on the coupon rate. So the very ordinary dividend that they expect to receive, that is all they're going to get if they have non-participating preference shares. But if they have participating preference shares, that means that the shareholders are going to receive two elements of payments on an annual basis. They will receive that fixed dividend, the same as the non-participating preference shares, as well as a fluctuating dividend that's going to be based on profits. So similar to your ordinary shareholders, where the dividend is ultimately based on profits and performance of the entity, they're actually going to have two elements of their payments. So one being the fixed annual dividend based on the coupon rate, and then a bonus or additional dividend that's dependent on the performance of the company itself. We're now going to apply this information we've just learned in terms of example 4 of the Gripping Garb textbook. This example says to us that a company has 1,012% non-cumulative, non-redeemable preference shares in issue, all at R2 each. The payment of the 12% preference dividends is entirely discretionary. These preference shares participate to the extent of 1/5 of the ordinary dividend per share. The ordinary dividend declared is 10 cents per share, and there are 1,000 ordinary shares in issue. The ordinary dividend and the preference dividend were declared on the 25th of December 20x5. You're required to journalize the ordinary and the preference dividends. Okay, so let's see how we would go about tackling a question like this. When we start off on the 25th of December 20x5, it's generally easier for you to start with the ordinary dividends first. They're typically less complicated, and a lot of that information is generally used to answer the participating portion of the preference dividend. Starting off with our ordinary dividends, debit our ordinary dividends, ultimately being a reduction of retained earnings, and credit the ordinary shareholders for dividend. When we look at ordinary dividends, they are based on the number of shares and the dividend per share. So the fourth bullet point tells us that there's 1,000 shares and the dividend declared is 10 cents per share. That ultimately means that our ordinary dividends declared in total will be a value of 100 Rand. Okay, we then work on our fixed preference dividend. Okay, so our fixed preference dividend is going to be based on the coupon rates. How do we work out preference dividends? We take the number of shares, which is 1,000 shares, times the value, R2 each, times by the coupon rate of 12%. That then gives us a preference dividend of 240 Rand. We debit our preference dividends, which is going to be a reduction of retained earnings, and credit preference shareholders for dividends. Then finally, we need to look at this bonus dividend that our preference shareholders are getting, and that is because they, as per the third bullet point, participate to the extent of 1/5 of the ordinary dividend per share. Okay, so we would use our ordinary dividend calculation of 1,000 shares times 10, and how much are they going to get? They're going to get 1/5 of that. Okay, so it would be the 100 Rand divided by 5 to get 1/5. That means that the preference dividends is going to get an additional 20 Rand. Okay, so exactly the same as you have done your previous journal entry. This is now your fluctuating dividend. Debit our preference dividends, which is a reduction of retained earnings, 20 Rand, and credit our preference shareholders for dividends. When looking at our ordinary shares, there was in fact an old Companies Act that was in effect, and this old Companies Act gave each class of share what was called a par value. Generally, they would have either par value or no par value. What a par value was, it was really an arbitrary value that was associated with a share. And if a share was sold above that par value, which generally it was, that excess amount over the par value was seen as a share premium. So you would then have a share capital account and equity as well as a share premium account and equity. But now with the new Companies Act, they've actually abolished this notion of having a par value. So any new shares under the new Companies Act are issued as having no par value. You might come across in practice as you work in commerce that you might find share registers where they do have still this old par value, and that's simply because when those shares were issued, it was under the old Companies Act, and they could have those arbitrary values assigned to different share capital. And so they will remain as such, so they're not going to change. They will still have their little par value, and they'll remain as such until converted to no par value shares. So all shares issued after the effective date are essentially no par value shares, and that is what you're expected to know for accounting 212. So our old Companies Act, you would have had these share issue costs, which were directly written off of the share premium account and then the share capital account. With the new Companies Act, your share issue costs are written off against the equity count, so off the share capital, unless that issue is abandoned. So say you have a prospectus that was sent out and you said that you want to issue shares and the minimum number of shares for subscription to take place is 100,000 shares. Now, if you only get applications for 80,000 shares, you've still incurred costs to provide the advert and for people to actually take these applications and the administration work. So you've still incurred costs, but you may not end up issuing those shares because the minimum subscription wasn't met. Okay, so if that is abandoned, then those share issue costs need to go directly to profit or loss. Any preliminary costs or startup costs are also taken directly to your profit or loss. So there are some restrictions as to what you can actually include as forming part of your share issue costs, because those share issue costs, if they're directly attributable to an actual share issue, will be then written off of the share capital equity account. Now you can also have what is called a conversion of shares. So where you convert from one class to another. Perhaps you have a whole lot of ordinary shares and you've got no preference shares, and maybe you just want to convert some of those ordinary shares to preference shares or vice versa. You might find that an entity wants to do that for the purposes of freeing up some of the issued balance so they can issue more shares. So say you've got a maximum authorized share capital of 100,000 shares and you've got 100,000 shares in issue. Yeah, so that means that you can't actually issue any more shares. What you could do is convert some of those shares to preference shares, and then you will have some available that you can then use to issue to new shareholders. So that's one of the ways to get around the fact of the ceiling on the authorized number of share capital. And you can also have an amendment to your incorporation document. So what you lodged with the registrar as being your authorized share capital, you can in fact amend that document through the purpose of a special resolution. So then you'd also be able to issue more shares. There's lots of different ways to get around it, and of course there are costs associated with each of the various options, but these are some of the decisions that businesses need to make when they reach their maximum authorized share capital that is issued. We're now going to look at example 8 from your Grip and Garb textbook. And this example says to us that there's 1,000 ordinary shares issued at R1.20, and these are currently in issue. On the 1st of Jan 20x2, 500 of these ordinary shares were converted into 12% preference share equity. You're required to journalize this conversion and disclose in the statement of change in equity for the year ended 31st December 20x2. And so here we can see what is ultimately the value of the ordinary shares that we are going to be converting. Okay, so we're taking 500 shares at a value of R1.20 each. So it means that the value of the ordinary shares being converted to preference shares is 600 Rand. If we are removing 600 Rand from our ordinary share capital, we need to debit it. And if we are increasing our preference share capital by 600 Rand, we need to credit it. Okay, so this is what is reflected in our journal entry. This is to show the conversion from ordinary share capital to preference share capital. So we expect to see in our statement of change in equity a reduction of ordinary share capital and an increase in preference share capital. And here if we look at our statement of change in equity, that's exactly what we've seen coming as a line item there in the second row. We've got the conversion of ordinary shares to preference shares. So preference shares increasing and our ordinary share capital decreasing by the 600 Rand value. So remember in our statement of change in equity, this is at Rand value, but in the notes we're showing the number of shares. We're not interested in the Rand value when we're looking at our preference share capital and our ordinary share capital notes. So it's important that we don't get it confused, because otherwise our financial statements aren't going to make sense. We're now going to look at what is known as a rights issue. So a rights issue is defined as shares that are offered to your existing shareholders in proportion to their existing holdings. So that means if you have 100 shares in issue and I have 20 of those shares, that means that I have 100 out of 20 out of 100, so I have 20% of the shares in issue. That then means if you are perhaps going to issue, say 500 shares, I would be allowed to purchase 20% of those 500 shares. So I would be allowed to purchase a maximum of 100 shares. So that's really what this statement is saying. So shares that are offered to existing shareholders in proportion to their existing holdings. So however much percentage they have of the total share capital, that would then be the maximum percentage they'd be permitted to purchase under a rights issue. Now, why would you have a rights issue? Ultimately, it's issued at a lower price than the market price. Okay, so say the shares are trading at 5 Rand each, you as an entity can say to your existing shareholders, well, you have been with me from the start, you are currently invested in us, so instead of paying 5 Rand a share, we're going to offer you this number of shares for 3 Rand per share. So wow, that's a big incentive, a lower price than what is included in the market. We do have a small example there. Shareholders offered 2 shares for every 5, held at a price of 5 Rand, when the market price is actually 6 Rand. So an incentive, a reduced price, and it must be in proportion to their existing shareholding. So we're now going to use this concept in the form of application and example. So example 9 from your Grip and Garb textbook says to us that a company has 1,000 ordinary shares in issue, and they were each issued at a price of 2.50 Rand. The company wishes to offer its shareholders 1 share for every 4 shares held at an issue price of 3 Rand each. Okay, so you can see that it's in proportion to the existing shareholdings. So if you own 8 shares, you would be allowed to purchase 2 shares. Okay, so in that proportion. How much do we have to buy these shares at a price of 3 Rand, and the current market price is 4 Rand. So we can see the incentive, the reduction in price per share. All the shareholders accept the offer. Now we're required to journalize and disclose in the statement of change in equity. So when starting with a question like this, we need to see, well, how many shares is the company actually going to be offering to the shareholders? So if there's a total of 1,000 shares and they're allowed to buy 1 for every 4 shares, how many can they maximum purchase? So 1,000 divided by 4 will be 250 shares. Okay, so 250 shares, we said 1,000 shares in issue currently, divided by 4, which is the ratio for purchase. And how many purchase can they buy per 4 shares owned? They can purchase 1, so times 1. 250 shares are how many we are actually going to issue. At what price are we going to issue these shares? At 3 Rand each, or at the market price of 4 Rand each? We said we're going to have an incentive here. We are going to issue it at a price lower than market price. And so we're going to issue those 250 shares at the reduced price of 3 Rand each. So the proceeds we're going to receive from the issue of these 250 shares is 750 Rand. So now that we have the calculations out of the way, we can proceed with our journal entries. So debit bank with 750 Rand and credit our ordinary share capital with 750 Rand. So those existing shareholders are going to physically give us 750 Rand to increase our bank account, and we are going to issue our ordinary share capital to the value of 750 Rand. How would this look in our statement of changes in equity? So as you can see, we've actually built quite a number of items that you would need to consider including in your statement of change in equity. We looked at the conversion from ordinary share capital to preference share capital. We looked at additional share issues. We looked at dividends that were taken out of retained earnings. And now we even have a rights issue where we are showing an increase in the ordinary share capital. So there's a number of different elements and rows that you can actually populate your statement of changes in equity with. It would be a very good exercise to go through a number of these elements we've included in the lecture, and so that you can have a nice exhaustive list and make sure you don't leave anything out when you are drawing up a statement of changes in equity. We're now going to talk about share splits. So share splits, what is the purpose of a share split? You're basically turning your shares into more shares. So what is happening here is, say you have 2 shares, you might split them in half. Now you're going to have 4 shares. So you're basically turning the shares you have into a resultant more shares. But why would a company want to do this? Well, if you have more shares, it results in a lower market price due to supply and demand, and it also improves the share marketability. So what are we talking about when we have a share split? So perhaps you have 200 shares at a price of 2 Rand each. So the value of those 200 shares would be 400 Rand. But if you have a share split, your 200 shares now become 400 shares. That does not mean that your Rand value changes, however. Your 400 shares are still worth only the 400 Rand as per your set of financial statements. So the 400 Rand divided by now 400 shares means that they're ultimately at a price of 1 Rand per share. Ultimately, there's no journal entry for a share split. All that is taking place is a change in the number of shares in issue. So where do you think a share split would feature in our financial statements? Would you see it in the statement of change in equity? No, there's no journal entry. There's no change to the value. It's still 400 Rand. Will you see it as a change in your ordinary share capital notes where you have the number of shares? Yes, you're going to see the opening balance of 200 shares and a closing balance of 400 shares. So a share split accounting for that difference of 200 shares. Now, the opposite to a share split is what is known as a share consolidation. So shares are consolidated, which means ultimately you have less shares. Now, this is often something that would take place within an entity, because this is a way that, say you've reached your maximum authorized number of shares of 1 million shares. You could do a share consolidation and then only have 500,000 shares in issue, and then you can issue more shares. So it results in a higher market price due to supply and demand, and it is, of course, as we said, the opposite of share splits. So using the same figures as we had with the share split, we're going to say previously we had 200 shares at 2 Rand each. So the Rand value was 400 Rand. Remember, this Rand value does not change. If the 200 shares are consolidated into now only 100 shares, we've still got that same Rand value of 400 Rand, but it is now divided by only 100 shares. That then means that the price has increased from 2 Rand per share to now 4 Rand per share. Again, no journal entry is provided, which then means what is going to happen? If no journal entry is required, we're not going to have any change made in our statement of changes in equity, because that deals with the Rand value. That Rand value is going to be stable at 400 Rand. But where will we have a change? In our share capital note, where we have the number of shares. Our opening balance will be 200 shares, but now our closing balance will be only 100 shares, with the share consolidation making up that movement of 100 shares. Okay, capitalization issues. This is quite similar to a rights issue, but with a rights issue, the shareholders are paying you for those additional shares. Capitalization issue means the shareholders are not actually paying you for the additional shares, but they're still being paid for. Now, who's going to pay for them? Well, the company pays for those shares out of their retained earnings. So shares issued to existing shareholders for free, they are fully paid up, but how are they paid up? They are paid for out of the company's retained earnings. So they're still paid, they're just paid by the company itself for the shareholders. So it can be a form of incentive. Maybe you don't want to pay out dividends that year, but you still want your shareholders to feel that they are being rewarded for taking risk and investing in your entity. You might want to provide them with a capitalization issue and give them more share capital. So it's done by converting idle reserves. Idle reserves, where are those? Those are sitting in retained earnings. That's converted then into capital. So we're now going to apply this knowledge in the form of example 12 from your Grip and Go textbook. This example tells us that already an issue is 1,000 ordinary shares, and they were issued at a price of R1.50 each. We're then told we're going to have a capitalization issue. This capitalization issue is going to comprise 600 fully paid up shares to existing shareholders in proportion to the existing shareholdings at the current market price of R1 each. Your retained earnings of R800 at the beginning of the year, and your total comprehensive income was R150 for the year. You're required to journalize and disclose in the statement of changes in equity. And so we said we are giving share capital to our shareholders, 600 shares at a price of R1 each. So credit our ordinary share capital with R600. We are issuing those shares to the shareholders, and we said they're going to be paid for, but who's going to pay for them? Normally, the shareholders would pay us and we would debit bank, but in this case of a capitalization issue, it's going to be paid for by the company using their retained earnings. So debit retained earnings with R600, and there we can see the movement from our retained earnings through to our share capital. So by debiting retained earnings, are we increasing it or decreasing it? We are decreasing our retained earnings. By crediting our ordinary share capital, are we increasing or decreasing it? We are increasing our ordinary share capital, and we expect to see this coming through in our statements of change in equity. We want to see an increase in ordinary share capital and a decrease in retained earnings of R600. So here is a visual representation of our statement of change in equity, our capitalization issue. We have an increase there of the R600 for our ordinary share capital and a reduction in retained earnings of R600. So we're issuing those shares to the shareholders, but the shareholders are not paying for them. We are paying for it directly out of retained earnings. We're now going to look at the financing of redemption. So very often you might get to 2 or 3 years' time, and now you perhaps need to redeem these compulsory redeemable preference shares. And we need to say, well, how are we going to come up with the money for this? So redeemable preference shares can be a liability or equity like we had spoken about previously, and that depending on the terms and conditions associated with redemption of those shares. We said if it's compulsory or at the option of the shareholder, the more prudent approach would be to recognize those redeemable preference shares as a liability, because we have no control over the shareholders as to whether they're going to redeem or not, and therefore the more prudent option would be to account for those as a liability. If the redemption is at the option of the entity, we assume that we're not going to want to redeem them. We want to keep these shareholders. That is the more expected outcome, and therefore we're treated as equity. So the manner of repayment, where you've got that first scenario of compulsory or at the option of the shareholder, it's a liability. We would need to look at various sources, internal, external, perhaps equity, to then finance the redemption of these redeemable preference shares. You might need to look at the fact of another loan, or perhaps you may need to issue more shares to other shareholders, or actually take out debentures, issue debentures. Typically, your redemption is done at a premium, so in excess of the issue price. It can also be done at a discount, but that's not often the case. Typically, your preference shareholders, where they've bought these redeemable preference shares, they do want some sort of premium to account for the risk that they have taken to invest in this company. The premium is usually offset against your retained earnings. So if you have purchased or issued the redemption, the debentures, I'm saying the debentures, if you have issued the redeemable preference shares at R1 million, but you're going to redeem it at 1.2 million rand, that additional 200,000 rand you're going to pay is usually offset against retained earnings. So that's really what that last bullet point is referring to. That's what they're meaning by that. And we're now going to apply this in terms of example 14, which is a very nice comprehensive example. I'm looking at a number of different scenarios and how you would account for those. So in example 14, the company is to redeem all its preference shares at the original issue price of R2 each. So here we don't have any complications in terms of redemption at a premium. They don't want to issue any more ordinary shares unless it's absolutely necessary. So if they do have to issue more ordinary shares, they will do so at a price of R6 each. So that's going to be our very last option that we would look at. What would be our first option? So bullet point 3, 80,000 rand in the bank, but we only want to use 30,000 for the redemption. So right, from bullet point 3, we know we've got 30,000 rand from the bank we can use to redeem the preference shares. If any more cash is required over and above that 30,000 rand we have available from the bank account, we can issue a maximum of 10,000 debentures at R1 each. Okay, so that would be another 10,000 rand we can get through the issue of debentures. So first option is 30,000 rand from the bank. Second option is 10,000 rand from debentures. If we still need more cash, we can get a loan of up to 40,000 rand. So that would be option 3. And then we said option 4, the last case scenario, worst case scenario, is we're actually going to issue more ordinary shares. We're told that we have retained earnings of 150,000 rand, and we're required to calculate the number of ordinary shares needed to be issued to finance the redemption. Remember that was going to be last resort, and all the related journal entries. So we're given 3 different scenarios in example 14. Scenario A, 10,000 preference shares are to be redeemed. Scenario B, 35,000 preference shares are to be redeemed. And scenario C, 70,000 preference shares are to be redeemed. So let's firstly focus on scenario A. We've got 10,000 preference shares to be redeemed. So how much money do we need to pay back for 10,000 preference shares? Well, they're going to be redeemed at a price of R2 each. 10,000 preference shares at R2 each means that we need, for scenario A, we need 20,000 rand. So look at the first column, please, of this table. How much cash do we need? We need 20,000 rand. Okay, so how much cash do we have available in the bank? Said we have 80,000, but we only want to use 30,000. Is 30,000 enough to cover the 20,000 we need? Yes, it is. So we can simply just use the cash in the bank for scenario A to redeem those 10,000 preference shares. What would the journal entry look like for scenario A? Well, we would need to move the preference shares from a non-current liability, we debit it, to a current liability, credit it. So we are showing the movement of the 20,000 rand that we need to redeem those preference shares. We're moving it from a non-current liability to a current liability. And then the very last journal entry is what's applicable to A, where we debit our preference shares with 20,000 rand and we credit bank with 20,000 rand. We're just using 20,000 rand that's available to us in the bank to pay out the redemption of those preference shares. Let's then look at scenario B. So scenario B is 35,000 preference shares that we need to redeem. Now, how much are we going to redeem them at? R2 each. So 2 Rand times by 35,000 preference shares means we need 70,000 Rand to finance the redemption of scenario B, 35,000 redeemable preference shares. So the cash needed for scenario B is 70,000 Rand. Right, let's move through our options. We said first option will be cash in the bank. We only want to use 30,000 Rand. How much do we need? We need 70,000 Rand. So is that enough? No, 30,000 is not enough. So we're going to use 30,000 Rand cash in the bank, but how much more do we still need? We still need 40,000 Rand to reach that 70,000 Rand goal. So we're going to go to the next option. The next option in the fourth bullet point said that we can get 10,000 Rand from debentures. Okay, great. So we've got 30,000 Rand from the bank, 10,000 Rand from the debentures. So we now have 40,000 Rand, but we need 70,000 Rand. So we're still short. We then move to the third option. Third option says if more cash is still needed, we can get a loan of up to 40,000 Rand. But how much do we need? We only need 30,000 Rand more. So we'll take 30,000 Rand in the form of a bank loan. So 30,000 Rand cash in the bank, 10,000 Rand from the debentures, and 30,000 Rand in the form of the loan. We then will have the 70,000 Rand that we need to redeem those 70,000 Rand worth of preference shares. Okay, so how do we journalize this? Well, firstly, that 70,000 Rand we need to shift from a non-current liability to a current liability. So debit preference shares non-current liability was 70,000 and credit our preference share current liability with 70,000. We then said, well, the first option was the cash in the bank. Do we need to journalize that? No, that money's sitting in our bank. What we need to do is we need to increase that cash in the bank until we have 70. So the new debenture issue, what will that look like in the form of a journal entry? Debit bank, we are getting money, 10,000 Rand, credit our debenture liability, 10,000 Rand. So our bank had 30,000 that we were going to use for the redemption. Now we've bumped up our bank by an additional 10,000 Rand from the debentures. We then said we're going to get a bank loan. So the bank loan, we're going to debit bank with 30,000. So we've bumped up our bank. We now have the full 70,000 Rand that we can use to pay for the redemption of the shares, and we credit our loan liability. Now we have the full 70,000. We can pay out and redeem those preference shares, debit the preference share current liability with 70,000 Rand, and credit bank with 70,000 Rand. Okay, we can then move on to our final scenario, which is scenario C. And scenario C says we are going to redeem 70,000 preference shares. So 70,000 preference shares at 2 Rand each means how much money do we need? We need 140,000 Rand. Okay, so let's go through all of our options and see how much money we can accumulate. Okay, so we need 140,000 Rand. How much cash are we going to want to use from the bank? We're going to use 30,000 Rand from the bank, but we need 140,000 Rand. So we don't have enough yet. We still need another 110,000 Rand. Next option, we're going to issue debentures for a value of 10,000 Rand. Okay, so 10,000 Rand we're going to get from the debentures. So now we have 30,000 from cash in the bank, 10,000 from debentures. We've got a total of 40,000, but we need a total of 140,000. So we still need 100,000 more. Sure, let's go to the next option. The next option, still need more cash. We can get a loan of up to 40,000 Rand. Okay, we're definitely going to need that. So we take out the new bank loan, 40,000 Rand. We now have 30,000 from the bank. We have 10,000 in debentures. We have 40,000 in a loan, which means we now have 80,000 Rand. But we have to get to 140,000 Rand. So we're still 60,000 Rand short. We're now going to our final option, which we said we really don't want to do, but if absolutely necessary, we can issue ordinary shares at a value of 6 Rand each. Well, yes, we're definitely going to need that because we need 60,000 Rand remaining from our new share issue. If we're issuing them at 6 Rand each, that means we're going to have to issue 10,000 shares at 6 Rand each to get that remaining 60,000 Rand that we need to redeem the payout for these preference shares. Okay, so now we have all the information and how we're going to finance this. We can then move on to our journal entries in this regard. So we start off with this 140,000 Rand and we shift it from a non-current liability to a current liability. We then said, well, the 30,000 Rand that's in the bank, do we need to journalize that? No, it's already in the bank, but we need to bump that 30,000 up to 140,000. So we move on to the next item, which was the debenture issue. We said we're going to issue the debentures, debit bank, credit our debenture liability with that 10,000 Rand. We then said our next step was to get a bank loan of 40,000 Rand. So we said we're going to get the money from the bank, we debit bank with 40,000, and then we credit our loan liability with 40,000. We then said our very, very final option to get the cash available that we need was through a new share issue, and that was going to be at a value of 60,000 Rand. So debit bank was 60,000, credit your ordinary share capital was 60,000. Finally, we have bumped up our bank accounts. We now have the full 140,000 Rand available in bank, and we can pay out that current liability in terms of the preference share redemption. So debit our preference share capital, current liability 140,000 Rand, and credit bank with 140,000 Rand. So as you can see, where you have this financing decisions to make, it can be very cumbersome, and it really helps us to test a number of different items within a single question. So it is a very nice way to test a number of different sections within a single assessment. And so we spoke briefly about this fact that you can redeem at a premium, and we said normally that's what's actually done out in industry. So redemption that requires a company to pay the preference shareholder an amount in excess of its issue price is referred to as a redemption at a premium. So say the preference shareholder bought the preference share for 2 Rand per share, but they're going to redeem it at 2.50 Rand per share. That additional 50 cents is what is known as the premium. The preference share, if it is mandatorily redeemable or compulsory redeemable, it is accounted for as a liability. But if it is not compulsory redeemable, generally it would be at the option of the entity, then we would account for that as forming part of equity. Now we're going to look at example 15 from your Gripping Garb textbook. And in this example, it says to us that a company is opting to redeem all of its 20,000 preference shares, which were issued at a price of 2 Rand. Now they're going to be redeemed at a price of 3 Rand each. So there's a 1 Rand premium on redemption for these 20,000 preference shares. The company will fund this out of a new share issue of 10,000 ordinary shares. The rest of the redemption payment must be funded by raising a bank loan. These preference shares were being redeemed at the option of the company and have therefore been recognized as equity. Scenario 1 is where the ordinary shares are to be issued at a price of 4 Rand each, and scenario 2 is where the ordinary shares are to be issued at a price of 3 Rand each. You're required for each scenario to calculate the cash required to finance the redemption and to show all the related journal entries. Okay, so we look at the first scenario. Well, actually in both scenarios, how much money do we need in order to redeem those preference shares? So it was 20,000 preference shares and they're going to be redeemed at 3 Rand each. That then means we need 60,000 Rand. And so now we know what we need. Now what's important is how are we going to get there? So they told us that they're going to fund it out of a new share issue of 10,000 ordinary shares. In scenario 1, those 10,000 ordinary shares are going to be issued at 4 Rand each. And with scenario 2, they're going to be issued at 3 Rand each. So that then means in scenario 1, how much money are we going to generate from issuing 10,000 ordinary shares at 4 Rand each? We're going to get 40,000 Rand from the new share issue, which means that how much money do we still need? We only need 20,000 Rand more to be able to redeem the 60,000 Rand for the preference shares. With scenario 2, the ordinary shares to be issued at 3 Rand each, so 10,000 ordinary shares at 3 Rand each, means that from the share issue, we will get 30,000 Rand under scenario 2, which then means we need another 30,000 Rand in the form of a bank loan to be able to finance that 60,000 Rand redemption of preference shares. When working with the journals, remember what is important is that part of these preference shares are ultimately going to come through in the form of our premium being taken directly from the retained earnings. So remember from our previous discussion, we actually said that the premium portion is going to be directly taken through from retained earnings. And we said in this case, it's issued at 2 Rand, but they're going to be redeemed at 3 Rand. Now, what is important is try and think of what happened when we issued these 20,000 preference shares. What would the journal entry have been? We issued it at 2 Rand each. So we debited bank with 40,000 Rand and we credited preference share capital with 40,000 Rand. So if we are now paying back for these 40,000 Rand worth of shares, do you think we can say, well, when we issued it, we credited preference share capital with 40,000 Rand. Can we now debit preference share capital with 60,000 Rand? And no, you can't do that. You can't have negative preference share capital. You're limited to the amount you, in fact, issued the preference shares at, which was 40,000 Rand. So when you're de-recognizing the preference shares, you can debit your preference share capital with only 40,000 Rand. But what are we redeeming? We're redeeming it at 60,000 Rand. So we're crediting preference shares, a current liability, at 60,000 Rand. So what is the difference between the 60,000 Rand we're redeeming it at and the 40,000 Rand we issued the shares at? That's the premium portion of 20,000 Rand. So we debit retained earnings with that 20,000 Rand because we can't simply say debit preference share capital was 60,000 Rand. We can't. Because when we issued it, we only credited share capital with 40,000 Rand. So we can't then debit it with 60,000 Rand and have negative 20,000 share capital. We're limited to debit our preference share capital at the issue price, which was 2 Rand times by 20,000 shares, so 40,000 Rand. And the premium portion of 1 Rand times 20,000 shares will be debited to retained earnings in line with the accounting standard. So that's the rule, is that the premium portion will be taken from retained earnings. So we are de-recognizing these preference shares that are being ultimately going to be redeemed. We are recognizing that there's a preference shares now as a current liability of 60,000 Rand that we have to pay out. And that has been taken 40,000 Rand from the share capital and 20,000 the premium portion from retained earnings. So now we've raised this preference share current liability and we in fact need to pay it out. We said that firstly we're going to do a new share issue for scenario 1. The share issue is going to generate 40,000 Rand, and in scenario 2, the new share issue is going to generate 30,000 Rand. Okay, so debit bank with the amount we're going to receive and credit our ordinary share capital. Then we said the next way we're going to raise sufficient cash to redeem these preference shares is through a loan. So in scenario 1, we said we need 20,000 Rand from the loan, and in scenario 2, we need 30,000 Rand from the loan. So debit bank to show that we are making receipt of the loan and credit the loan for scenario 1 and 2. Now we have raised enough money and we can in fact pay out that preference share current liability that we have raised, debit our preference share, our current liability of 60,000 Rand and credit bank to pay out and actually provide for the redemption of those preference shares. And we're now going to go through another example, example 16. It's very comprehensive and really puts a lot of the information that we have learned all together within a single example so we can draw on all of our knowledge. So in this example, on the 1st of Jan 20X1, a company issued 50,000 10% redeemable preference shares of 2 Rand and 100,000 ordinary shares at 3 Rand 50 each. The preference shares must be redeemed on the 31st of December 20X3 at a premium of 20 cents per share. The 10% preference dividend is based on a deemed value of R2 per share, and the payment of the dividend is mandatory and is due on the 31st of December each year. The effective rate of interest on the preference share liability is 12%. The authorized share capital consists of 120,000 ordinary shares and 100,000 preference shares. The company redeems the preference shares on due date, the 31st of December 20X3. In order to finance the redemption, it issued the remaining authorized ordinary shares on the 20th of December 20X3 at R4 each. So if we look at the ordinary shares, we had 100,000 in issue and 120,000 was authorized, which means that we could still issue an additional 20,000 ordinary shares. Further cash of 20,000 Rand can be used from savings, and thereafter a bank overdraft can be arranged. The accounting policy is to set off any premium on redemption against retained earnings, which we are well aware of, that the premium of the 20 cents per share will be set off against retained earnings, which has a current balance of 200,000 Rand, and our retained earnings on the 1st of Jan 20X3 was 220,000 Rand. The preference shares have been correctly classified as amortized cost financial liabilities. The total comprehensive income before the above information was 100,000 Rand. You're required to prepare the journal entries and disclose in the financial statements for the year ended 31st of December 20X3. So a lot of information all consolidated within a single question, and we can draw on all of our knowledge to apply it when we are generating our solution. So we firstly need to calculate our financing plan. We need to understand that we are redeeming these preference shares, and we said in the second bullet point that they're redeemed at a premium of 20 cents per share. Our first bullet point told us that we have 50,000 redeemable preference shares. They were R2 each, but they're going to be redeemed at R2.20 each, 20 cents premium. So how much cash do we need? 50,000 shares times by R2.20 means we need a total cash value of 110,000 Rand. How are we going to actually finance this? Well, they said that they're going to, in order to finance it, they're going to issue the remaining authorized ordinary shares at R4 each. We said there was 20,000 ordinary shares that we can still issue. So it's 20,000 shares at R4 each means we'll gain 80,000 Rand from that ordinary share issue. And now that's still falling short of the 110,000 Rand that we need. So we go back to the question to see where else we can draw finance from. They told us that 20,000 Rand can be used from savings. So savings gives us 20,000. That now means we have 100,000, but we need 110,000. We then said thereafter a bank overdraft can be arranged. So we're going to go into overdraft for the final 10,000 Rand that is required to finance this redemption. To journalize this, we firstly want to look at our new share issue, where we're going to generate 80,000 Rand. We're going to debit bank with 80,000 and credit our ordinary share capital with 80,000. Our redemption of the preference shares, we are ultimately moving that financial liability to a current liability. We're saying that 110,000 is going to be paid out very shortly within the next 12 months. How is that going to in fact be paid? We're going to debit the current liability because we're settling it. And how are we settling it? From our bank, which is 100,000 Rand, because we have 20,000 cash in the bank, and we got an additional 80,000 Rand cash in the bank as a result of the new share issue. So we have 100,000 there, and then we're crediting our overdraft with the final 10,000 Rand that was required. When we look at our statement of profit or loss and other comprehensive income for the year ended 31st December 20X3, there we see our finance charges. And if you go back to our previous examples, it really is just drawing on the effective interest rate table and pulling it through in the form of the finance charges itself. We then have our statement of changes in equity. Here we have the ordinary share issue of 80,000 Rand. We expect to see that coming through. Why is there no preference share capital here? Because we said it is a a liability. It was a financial liability. So it does not form part of equity and it cannot be included in the statement of changes in equity. Okay, what do we expect to see in the statement of financial position? So each of our columns here, so ordinary share capital and retained earnings, we would see a line or a row for each of those items under equity in the statement of financial position. What we do expect to see for our non-current liabilities would be the closing balance in 20x1 as in agreement with our effective interest rate table. And then that would shift then in 20x2 to be current because it will be paid at the end of x3. And that balance as well would be directly driven from our effective interest rate table. It's not something you should be calculating over and over again. Our accounting policy, what do we expect to find here? For preference shares, the fact that they are redeemable on what date? The 31st of December, 20x3. If they're compulsory, you state that, or at whose option? The option of the entity or the option of the shareholder. It's recognized as a liability because we are applying the concept of substance over legal form. And in substance, this forms a liability. The dividends are recognized in the statement of profit or loss and other comprehensive income in the form of finance charges. So those finance charges really encumber both the dividend element and an interest element. Using our effective interest rate method, what is that effective interest rate that has been applied for your preference shares? Your ordinary stated capital, remember, it is the number of shares. We don't want to see the rand value here. The authorized number of shares is 120,000, and then how much is an issue? Show your reconciliation. For 20x3, that's particularly important because your opening balance is 100,000 shares, but then you issued 20,000 during the year. So currently in issue at the end of x3 is the full value of 120,000 shares. So we're now at the maximum and we can't authorize or issue any more shares more than the 120,000 that we already have because we've reached the authorized limit. Our redeemable preference share liability, make sure that you name it correctly. We again show the number of shares. So this is also particularly important for 20x3 because we had an opening balance of 50,000 preference shares in issue, but then we had a redemption during the year of the 50,000 shares. So at the end of x3, we actually have no preference shares that are currently in issue. Then to finish off share capital, we need to look at the solvency and liquidity test. So a company cannot simply just declare dividend. So you might think it's easy. They just sit in a nice little meeting and decide, okay, we're going to give 10%, 10 cents per share. Okay, it doesn't work like that. They actually have to make sure that there are certain criteria are met when they go about deciding on whether they can even declare a dividend. So the following must be met. Firstly, the distribution. Is it pursuant to existing legal obligation of the entity or a court order or board of the entity has authorized the distribution by resolution? So typically, the final bullet point there is what would be satisfied, that the board of directors would have authorized the distribution in the form of a resolution. So they've done some form of vote on the distribution in the form of dividends. What is important is the next bullet point. Reasonable appears that the entity will satisfy the solvency and liquidity test immediately after the proposed distribution. Okay, so they need to actually document in their meeting that they've applied their amounts and they've made sure that after they have paid out, say, this 500,000 Rand dividend, will the company still be solvent and will they still be liquid after that payment of dividends has been made? Okay, so this is very important because if the board doesn't actually perform this exercise, they will be in big, big trouble and they will be in contravention of the Companies Act if they do not make sure that this has been satisfied before authorizing the distribution of a dividend. Okay, so this is very important because when you have a board of an entity, they must always act in the best interests of the entity and the shareholders. So they can't act in their own best interests or in the interests of perhaps their wife or their husband that actually has a massive amount of shares in the company and just say, yeah, I think we should issue a huge dividend this year, and the company ends up closing down. And so they can't be self-satisfying. They need to make sure that this company is actually still going to be solvent and liquid after the dividend is paid out. So the board of the company must have applied the solvency and liquidity test for them to be able to authorize that distribution. So we're talking about the solvency and liquidity test, but what does it really mean? So if a company is still solvent after the distribution, it means that the assets at fair value must exceed the liabilities at fair value. So solvent, total assets must exceed total liabilities, and liquid, they must have the ability to pay the current debts as and when they fall due within the following 12 months after the test or the distribution of those dividends. So that's to ensure, like we said, that the company does have longevity and they are going to continue for the foreseeable future. And the distribution of this dividend isn't going to be something that's detrimental and cause the company to close down. So it's an incentive for the shareholders, but it must be something that the entity is able to carry and be able to afford.